Okay, guys. So let's get cracking. Penultimate day of quarter one, 2017. So we'll be rounding off quarter one in tomorrow's session. But let's get the briefing up and running here. I have to say there's a lot I want to try and cover in hopefully quite a short space of time here. So without further ado, let's get started. Now, first thing, let's talk about what's happened most recently before we look back at tomorrow. Look back at yesterday, look back at the Brexit situation, look back at the ECB and all that kind of stuff. What did Fed members say? What's going on over in Trump land? Before we talk about that stuff, let's just talk about what's gone on this morning. So here's the Bund, German 10-year, has popped higher this morning. And this is adding to the gains that we had yesterday, and pretty steep gains that we had around about lunchtime yesterday afternoon. The Bund driving higher. We've broken up through yesterday's double top now this morning. Today's move this morning is off the back of some German data. So we've been getting some regional inflation numbers out of Germany today. And if we just had a very quick look actually at the calendar, check out the economic data calendar for today. And so what we're going to have all morning, and there's a whole batch of these coming at 9 a.m. as well, but it's German inflation day. So this is for March, and we've got all the regions reporting as usual. So we've had Saxony report at 8 o'clock. We will get the likes of Brandenburg, Bavaria, and so on reporting at 9, and then if I just skip down later this afternoon at 1 p.m. we'll get the whole nation, the total net German inflation print overall, which is expected to be at 1.9%, which is a drop from the 2.2% that we saw last month. So with this Saxony one, now that's been delivered. I don't have a chart for it, unfortunately, but I got a chart of the German one. So this is the national one overall. So 2.2% for February. We're now expecting this to drop. We were expecting it to drop anyway to 1.9. I would say these regional numbers that have just come in maybe indicate we might be in for a larger drop than expected. So a print below 1.9. Of course, this is significant because this puts this rate back below 2%. That's the kind of ECB's line in the sand, if you like. That's their target rate. And so we've had a real steep inflation climb as we hit the end of last year and the start of this year. And it looks like, given these regional numbers this morning from Germany, that this upside spurt is perhaps just losing some momentum. Obviously, we're going to want to see in the coming months whether or not this is the top. Is 2.2% the peak in this little blip higher for inflation? Is inflation going to settle down back below 2% as we go through the summer or not? And so obviously this is just one print, and you can't really tell a trend from one bit of data. But if we just transition back to the charts, this is what's led to the Bund popping higher. Remember, if inflation very important for sort of longer duration bond yields, and so when inflation drops, yields drop. If yields drop, well, prices go up. So this is the Bund just popping higher here. Just to put this in context, if you quick look at the daily chart, then, well, we've got a bit of a rollover situation here, but we've definitely got, this is quite important when we're looking at the daily continuation. Let me just go to actual non-continuation. It might look a little bit more sensible. We've got a long way to go to get anywhere near the top of the year that we had back towards the end of February. But this has been a pretty sustained move and rebound now over the last few weeks. Having almost flirted with the low of the year when we sold off to that low mid-March, it's now been a pretty decent rebound, and that rebound is continuing. Let's check the euro, because we're testing the low right now as I speak, and it's not only this morning's low, it's yesterday's low. Steep downside for the euro yesterday as well, and let me just make this chart, and this is continuing what seems to be a downward trending theme now. We're going to hit a top up at 109.50 back on the 27th, and it's certainly been a downward trajectory. the reason for the burst lower yesterday, which was also the reason why the Bund moved higher yesterday, and perhaps why we're continuing to look to extend this downtrend here for the euro, is mainly about ECB commentary that we had yesterday. This is being added to by this lower than expected inflation print out of Saxony in Germany this morning. So look, tests of the low right now, just be careful. Technically this is important. Let's just have a quick look on the daily chart just to get a feel, because we've definitely had a very strong move higher. And basically what the ECB did yesterday, in my view, was, hang on a minute, we're flirting with the 110 handle. The ECB do not want the exchange rate at 110, so let's start talking it down. And of course they've achieved that in the short term at least, and these inflation numbers are helping. So it's about perhaps this exchange rate tracking back towards 107. We did have some Fed speak yesterday, I'll touch on. Hawkish Fed comments helping with a bit of dollar strength also, contributing to this move. So I wouldn't be surprised if this downward trajectory continues, and just be aware of that low that we had back on the 21st of March, 107.67 on the futures. So what did the ECB say? Well, I mean, the problem with this was it was around about lunchtime yesterday. The problem, of course, was the media were all over the Brexit story, a media frenzy. Theresa May signing off the Article 50 letter. It's official. The 2-year countdown has begun. And, of course, the media were all over that. But actually, that was the least surprising event that we've had for quite some time, in that we've known that Article 50 is going to be triggered by the end of March. I mean, you could go back to last year. All right, we had some risk on that when it materialized that the government lost their case in the courts, and they had to get Parliament to sign off a bill for Theresa May to trigger Article 50. That put a little bit of a spanner in the works, but ultimately it didn't matter. So the fact that Article 50 has been triggered by the end of March should be of pretty much zero surprise to anyone, which is why actually in terms of market movement yesterday, it wasn't the big story, even though in the media it was. So the ECB news kind of went under the radar, and yet was certainly the most important headline of the session. If we go to a 5-minute chart and have a look at how this played out on the euro, just to zoom in, we definitely had easily the biggest move of the day here, as you can see on the chart. Big step lower. This was around about 12.50, and it was quite subtle, and you've really got to be on your game to have been able to take advantage of this, not only because the subtleties of the information flow is not straightforward to interpret, but also then the reaction was very fast. So you needed to be an ECB expert to get any kind of action off this move. But what the ECB said, and it wasn't the ECB directly, and this is the issue with some of these headlines, the source was just very vaguely ECB sources. And actually drilling down into the report, it was 6 different sources from the ECB. But that was it. We don't know who they were. But anyway, the message was that the ECB communicated via their sources that the market overinterpreted the message sent out at their last policy meeting on March the 9th, where markets were swift to start pricing in some rate hikes. So look, let me go back to that daily chart I just showed you of the euro dollar. What they mean here is, this is the swift pricing in. Look at the euro's value. So on the 9th of March, ECB day, we were right down here just before the meeting began. We hit a low just shy of the 105 handle, let's say. Then we had a bounce. Then we had big upside the following day on the 10th. And look, it just we haven't looked back. And this thing's been driving higher ever since. This is euro strength off the back of markets interpreting the March the 9th meeting hawkishly and starting to think about things like tapering. Are the ECB going to announce tapering in September and start tapering their QE program at the beginning of 2018? Are the ECB going to have a one-off deposit rate hike before they start tapering? And markets were really genuinely starting to price in a deposit rate hike by the start of next year. This was off the back of the ECB trying to communicate that economic conditions had improved, and they were trying to communicate that tail risks had reduced, and markets interpreted that very hawkishly. And these source comments yesterday were basically trying to educate the market and try and educate us by saying, look, you misinterpreted it. And actually, here's a quote from the piece, and they said, so the article quoted its sources and saying that a previous mentioned deposit rate hike prior to the unwind of QE purchases, and here's the quote, that idea, hiking the deposit rate prior to the unwind of QE purchases, would be a communication nightmare, and that if you raise rates, you can't communicate that it's a one-off. The market would immediately price in a new rate path. So quite dovish comments, trying to unwind the hawkish reaction to their last meeting. This is very difficult, if your experience levels when it comes to dealing with ECB developments, if your experience levels are still relatively low, then it's phenomenally hard to, in real time, pick a headline out like that and understand what it means, and then actually be able to trade and take advantage of it. But this is the world we live in, I'm afraid. The subtleties on the outlook going forwards of monetary policy and the subtleties of how that message changes still drives, sharp movement. It's just the movement doesn't last very long anymore. So that was the big move of the day yesterday. We're adding to that this morning with the Bunds on the upside off these inflation numbers. How did this play out in the equity space? Well, certainly good news for the DAX. The only reason the DAX has moved higher here, and we punched a bit higher yesterday, nothing aggressive by any means, and the only reason this is happening is because the euro is weakening. So as the euro weakens, this is good news for the DAX, good news for German exporters, of course, and so we move higher. The DAX had a decent session yesterday. Most of the move was actually prior to that ECB commentary, it has to be said, but it's been a decent week for the DAX. And when we're looking on the daily chart, we can see that actually, we're really up at, stretching their legs, new highs for the year here. And so that move higher we had back on Tuesday broke through the mid-March high, and so we have a new high for the year for the DAX. And if you want to go back further, then German equities are priced up at the highest point they've seen since the start of 2015. So you've got a 2-year high here, but that 2015 top, which is the all-time high, incidentally, just up at 12,438 on the futures. So that's something to be mindful of. And this isn't just about the ECB, obviously. This is about genuinely, for once, for the first time in a long, long time, you've actually got some pretty decent economic data coming out of Europe generally, with Germany leading that. When you're looking at PMI figures and so on, then, actually when you're looking at, if you're taking the whole world, global, I've forgotten the name of the index now, but it's the positive surprise index. It's not called that, but that's basically what it is. It's trying to take all economic data globally and basically how many of these data releases are surprising on the upside relative to how many are surprising on the downside. We're at a 6-year high. So you could say economic measurements are now at the best they've been for 6 years in terms of surprising, in terms of beating expectations. And this is a European story as well. And so perhaps this is helping with the sentiment. And this is something Deutsche Bank have been talking about. Let's have a look at the S&P now. And just before we talk about Brexit, let's deal with the US. And let's deal with this Trump thing. And let's deal with what was supposed to be the beginning of a sell-off. 21st of March, big step lower on S&P. And it was like, right, this Trumpflation trade, is it going to start to unwind? This is when the Obamacare bill to repeal Obamacare, failed in Congress, and it perhaps at that point was an indication, hang on a minute, is Trump going to be able to get any policy through this Republican Congress? If he can't get his Obamacare policy through here, maybe that means all the tax and the fiscal stimulus side of his policy ideas, perhaps they're not going to get through either. And so this is why we kind of started to sell off some of this, strong upside we've had since Trump's won the election. But look, we're already rebounding, and to be honest, we're not far off the price point we were before that that whole incident played out. So what's this all about then? And I think there's two sides to this. Number one, it might lead to, I mean, we thought that this Obamacare bill was going to take a couple of months to actually get through Congress, and if they were to sign it off, and I'm just seeing the dollar index hit 100, by the way, so the dollar index is testing the 100 handle as I speak. But the idea was that the Obamacare bill would take a couple of months, i.e. it would just take up time, not only for Congress but also for the Trump administration, and only once that bill was done would then they turn their attention to the tax reform stuff. And then that would take maybe 6 months, and maybe by the end of this year we might get some kind of deal on tax. But because Obamacare has failed straight away, that's the bill in Congress to repeal it, Trump's perhaps suggesting that he's going to straight away now turn his attention to the tax stuff. And so maybe we're going to get movement on the tax reforms earlier than we thought. That doesn't mean the tax reforms are going to get through Congress, mind. That's perhaps one reason. The other reason is then what I've just talked about, and that is that actually globally, and definitely in the US, we've got strong economic data. So maybe some of this upside for the S&P, yes, we've been, let's say, sidetracked. We've kind of got one-dimensional minds on the fact that Trump's responsible for everything, and this is all Trumpflation. But maybe there is an undercurrent of positive economic sentiment globally that's also helping to sustain some of this sort of elevated price point for US equities. So we'll have to see how data obviously pans out as we start to get into the summer. Are these PMI accelerations sustainable or not, obviously? With regards to Trump, I got a good graphic. Before we do, we obviously have to talk about Brexit, but just quickly, here are some questions. I'm going to just show you something, and this is quite an interesting piece from Deutsche Bank. So this is where Deutsche Bank clients asked Deutsche Bank some questions, and they've responded by the way of a research piece. So how much fiscal stimulus can President Trump implement, and how soon? Right, and surely that's the big question for markets globally, isn't it? That's why markets have been pricing in large stimulus pretty soon from Trump. That's why, isn't that half the reason S&P's high? Or at least we thought it was. And so the answer here is, well, so how much fiscal stimulus can Trump implement and how soon? Well, Deutsche's answer is not at all, and it will take significant additional time this year. So lacking a supermajority in Congress, Trump will have to resort to the reconciliation process to pass the budget legislation. This precludes increases in deficit spending. We're actually right now at risk of another government shutdown in April, by the way. The other thing that's interesting on this, how does the political calendar / timing of the next election affect prospects for budget legislation? Now here you've got to realise that we've got midterm elections in 2018. So in November 2018, one third of the Senate is up for re-election, and then the entire of the House of Representatives are up for re-election, November 2018. The point Deutsche are making here is, if Trump can't get any legislation through, like significant legislation, if he can't get it through this year, or at the very, very latest, by the very start of 2018, well then forget it. Because in an election year, trying to get any meaningful large-scale legislation through Congress who's self-obsessed with just trying to get re-elected is almost impossible. So we have got a countdown. Trump doesn't have much time, and it might mean that he rushes it, and I would say that right now, chances of getting any kind of meaningful large-scale corporation tax cut through Congress in time before the midterms really pick up in momentum, I think maybe now, maybe we're at risk of Trump not delivering any fiscal stimulus until 2019. So this is something to think about. Anyway, that's on the Trump side. Look, let's talk Brexit. Obviously, dramatic day yesterday. We knew it was coming, but just to say the least, it will be a day that goes down in history. It'll be the most important day for the UK until 2 years' time, which will then become even more important when we actually leave the EU. Yesterday was just beginning the process of leaving. So what's going to happen now? Well, here's the deal, and this is what the EU have said. They want 3 phases to the negotiation. Phase 1, the withdrawal, and this is expected to take 6 months. So actually between now and June is preparation time and the small matter of a couple of French presidential elections. Then 6 months for the withdrawal. This is settling the divorce. So what does the withdrawal negotiation include? Well, it includes an exit bill. Now this is huge. I mean, worst case scenario, this whole negotiation falls at the first hurdle where neither party can agree on a sensible exit bill, and the whole thing just fails at the start, and the UK leaves the EU in 2 years' time with no deal whatsoever. That's worst case scenario. The EU have been talking about a 60 billion bill. The UK have called that absurd. So that's the starting point on the divorce cost. 60 billion, please, and the UK, don't be stupid. So how we reach some middle ground, who knows, right? So that's key right at the start. Secondly, citizens' rights. This involves 4 million people. That's 3 million EU citizens living in the UK, and that's 1 million UK citizens living in the EU. What happens to them? And then Ireland. This is obviously the only place where there's a physical border between the UK and the EU. That's the border between the Republic of Ireland and Northern Ireland. What happens there is key as well. This is phase 1. That's the exit, or let's just call it the divorce settlement. Now the EU are saying that has to be negotiated before phase 2 can even start. Here's phase 2. Phase 2 is the future relationship. So the EU are adamant, until the divorce settlement's agreed, we're not interested in starting negotiations on the relationship after the divorce. Now here the UK have got a different opinion. They don't want to wait until 2018 to start talking about the future relationship. The UK want to have 2 parallel negotiations going on. One on the divorce, and then also let's get going straight away on the future relationship as well. I can kind of see the EU's point here. I mean, how can you agree on a future relationship until you've you know what the divorce deal is? I don't know. It's difficult. Anyway, whether the UK are going to get their way here is probably doubtful. If they do want to get their way, they're going to have to, give away concessions to the EU, and that will mean a larger bill for exit. And that won't go down. I mean, can you imagine the UK electorate slapped with a 60 billion euro bill for leaving? That might change people's opinion on the merits of this Brexit idea. But anyway, when phase 2 gets going, let's say January next year, this is all about then divergence disputes. So this is like the complex, the EU have called this the most complex part. So divergence. So this is all about the trade deal, obviously. What's the relationship going to be between the two parties after the UK has stepped outside of the EU? So the EU-UK arrangement must deal with regulatory divergence, not convergence. And this is the big difference. Pretty much every other trade deal in the history of the EU has been with a country, and the part of the deal is, right, fine, you can have access to the single market, but you have to bring your regulatory systems further into line with the EU. So the EU have insisted on a convergence. Now here, of course, we're going to have a divergence. The UK right now today lives under EU regulatory oversight, and that's what we don't want anymore, and we're stepping out of that. And so this is what makes this trade agreement quite difficult. Barnier, he wants a trade deal, so that's the EU. That's on the EU side. He wants a trade deal so ambitious it would restrict social dumping. So from worker rights to tax regimes to antitrust and subsidy rules, the more closely entwined the British economy remains, the more the EU side will want to curb Britain's freedom to undercut the EU as a competitor. Obviously, market access. The EU are going to be pretty uncompromising here, probably. Northern Ireland's a big issue, of course. Is there going to be a physical border? How's that going to work? And then obviously for London, the financial services sector, this is huge. Once that's done, and I don't know, chances of getting that done in 6 months, personally I think are literally impossible. But anyway, assuming somehow there's a miracle. Phase 3, so phase 1, divorce. Phase 2, what's the future relationship going to be? Phase 3, can we have some kind of transition period to actually implement all of this stuff? So that's a transition period that begins at the end of March 2019 and lasts for I don't know how long. So let's say 3 years is a number that's been thrown out there. And this is a period of time for the UK to implement the new relationship. All right, these are the 3 phases. There's then a phase 4, which the FT haven't talked about here. Phase 4 is, right, if we get all this agreed by the end of October, that gives us 5 months to ratify it in every single EU court. Oh, sorry, not court, Parliament. It might go to the courts, but anyway, Parliament to start with. This is where every single EU country independently has to ratify this agreement in their own Parliament. And this is another big banana skin. If you remember what happened with the last year with the EU negotiating a trade deal with Canada, when essentially the agreement had been made, right, let's ratify this in all the EU courts. And you might remember a tiny little region in Belgium voted no. Every other country. So actually, when you think about it from a population point of view, there's 500 million people in the EU. This region in Belgium has 3 million people. So 497 million people via their elected parliaments voted yes. 3 million people via a regional parliament in Belgium voted no, which meant the deal couldn't happen. In the end, it turned out that they got through it. But my point is, ratifying this throughout Europe is no small challenge in its own right. So this is the timeline, okay? This is what's supposed to be happening. Let's look at a couple of other things. This is a good graphic looking at what the timeline going forwards. What we've got here, the bottom line is the whole 2-year and beyond period. And what we've got is a zoom in on Q1 of this year. So what's happened, or let's just say March and then through to May, what's going to happen in this little section. And obviously we've triggered Article 50 here, 29th of March. We're now going to expect Tusk to publish Brexit guidelines within 48 hours. We've got a Eurogroup meeting apparently on the 7th of April. We've got a French first round election 23rd of April. The big meeting will be the Brexit EU summit on the 29th of April. This is sandwiched between the 2 French elections. I mean, I don't know what can get done in that meeting given the French political uncertainty in the mix there. But this is all part of this preparation time. See it here on the longer term on the bottom, you've got your 2-year negotiating window, end of March 17 to end of March 19. Here, October 2018, this is where they're hoping for the deal to have been done. So that gives us 18 months. I think that is fantasy world. We'll see. Then obviously we see, is there going to be a transition deal or not? So this is a pretty good graphic, just summing it all up. What else? So today, something else of note, landmark day today, as a result of yesterday's triggering of Article 50. Today is the day where Brexit sovereignty plans set out in the Great Repeal Bill. So this will be all over the news today. And again, this is not market-moving news. This is an inevitable follow-on from triggering Article 50 that we've fully known about for a long time. Here's a summation of what this means. What is the Great Repeal Bill actually repealing? So this is initially, the legislation repeals very little. So what the plan is it's to scrap the European Communities Act of 1972. All that does is end the applicability of EU law in the UK. But the Great Repeal Bill, its first purpose is to place the entire body of existing EU law onto the UK statute book. So here's the deal. Let's take the entire EU legal system we've been living under for the last 40 years and let's just make that UK law. Then, after Brexit, we can start refining and reforming these laws one at a time. And there's thousands of these things. Okay, it's going to take who knows how long, a decade maybe, to actually sift through this lot and say, right, is that a law we actually want as the UK? It's been forced on us by the EU, but do we actually want it or do we want to change it? And this is a process that's going to take maybe 10 years. So the idea is, look, let's just start where we are now by just taking what we've got and just creating it as UK law. So that's what this bill is about today. Okay, and this isn't coming into force yet. It doesn't come into force until the end, until Brexit, until we leave the EU. Okay, so that'll be on the headlines today. What else have I got for you? Here's the negotiators. So who to look out for? Obviously, negotiations will start not straight away. We're looking for that to begin in June. Who have we got on the UK side? Well, we've got David Davis. He is the Brexit secretary, unfortunately. So he's heading up negotiations here with his team. And so we got a guy called Oliver Robbins. He's the permanent secretary, Department for Exiting the EU. We've then got Katrina Williams, who's the deputy ambassador to the EU. And then I don't know why they blacked Denzil out here. That's really weird from the FT. I don't know why they've not shown his face, but anyway, Denzil Davidson, special advisor. So these are the kind of the top level team on the UK side. And who are they fighting against? Well, this is the EU side, and Barnier, he's the chief negotiator for the EU. Okay, and who's in his team? Sabine Weyand, who's EU deputy chief negotiator, and then you got these guys, Hubner and Hubert Legal, great name. He's is that genuine or is that a typo? Hubert Legal is the legal director. That's genius. If that is his real name, I applaud that appointment. Who's to say your name doesn't help you get jobs? Love that. Anyway, this is the EU side. So keep an eye out for these guys. It will be the case that when these negotiations get started, when these guys start saying stuff, I mean Twitter, I mean Bloomberg, headline risk, any comments from these lot are key. Really insightful potentially to how the negotiations are panning out. All right, what else have I got for you? I've dealt with the ECB. Let's talk about the Fed very briefly, only because when I was looking at, and let me just transition back to the charts. You've got this euro dollar move, to the downside. We broke yesterday's low there. I'm just going to draw that line back in, which was the earlier overnight low. We've broken that down to S1. Look for that as resistance. So this euro weakness continues, just bottom right. Just zoom in. The Bund move to the upside continues as well. But with the euro dollar, some of that move is certainly dollar related. So we had a couple of important, perhaps important Fed comments yesterday on the hawkish side. And I'm just trying to find the quote now. Well, it's Rosengren. I can't find the quote, but it doesn't matter. Rosengren basically said, yeah, I can see hiking rates once a quarter this year. I can see hiking rates once every other meeting. Basically implying 4 rate hikes in 2017, not 3. We also had Feds Williams, who, hang on, I've got another graphic for Feds Williams. Here's Feds Williams. And he was saying, look, economic conditions are good. He was lauding the recovery. 3 more hikes this year are possible. So a couple of hawkish comments out of the Fed to add into the mix yesterday. What else have I got for you? Right, well, let's just have a look then at the data calendar for the rest of the day, because we've just had, sorry, I've just missed it. We've had some further regional numbers on inflation out of Germany. So Hesse, annualized inflation at 1.7%. That's for March. February was 2.5, so big drop in Hesse. That is a big drop. 2.5 chopped back to 1.7. Bavaria in March, a drop to 1.7. In February, Bavaria inflation was 2.1. So also, wow, Brandenburg in February annualized inflation was 2%, and that's been chopped back to 1.4. So you've definitely got some big steps lower here on regional inflation numbers out of Germany. Almost certainly you're going to get the headline when it's announced at 1 p.m. this afternoon, clock in lower than 1.9, which is what the expectation is. Okay, so soft inflation numbers here this morning from Germany, helping with these moves on the euro, helping with the moves on the Bund. Right, 10 o'clock, we've got some sentiment numbers out of the EU. This stuff's not particularly important, I have to say, even though it looks like it might be. Economic sentiment, consumer confidence, this stuff doesn't really get much of a look in terms of having a market impact. But anyway, it's coming at us at 10 o'clock. More importantly, though, probably this afternoon, we get the final reading for quarter 4 GDP. This is quarter 4 of 2016, bear in mind. We're at the end of quarter 1 2017 here, so it's very old news, but it's the final revision. We're expecting it to edge marginally higher to 2%. This shouldn't have much of an effect because it's so old. You know, it's all about looking forwards. What's going to happen in the second half of 2017? Can the current strong data momentum continue? Is this strong data momentum driven by optimism created by Trump promises? And when reality bites and Trump promises drift away and get clogged up in the realities of Congress, and we realize, hang on, Trump's not going to deliver here, is that going to damage optimism, which will then see a deterioration in economic momentum? Really, I think that's the big question for the second half of 2017. Initial corporate jobless claims at 1:30. We've got some speakers down here in the mix. We've got Fed's Mester, Kaplan, Dudley, Williams again. So plenty of Fed talk. Yesterday they were hawkish. Are they going to back it up with more hawkishness today? And if so, well then that dollar strength theme will continue. The dollar index, as I mentioned, bang on 100 right now. And we'll see if this euro dollar move to the downside continues. Right, I think I'll leave it there for now, guys. That's plenty of angles covered off there very quickly. But yeah, lots to think about as we drift into the end of quarter 1. All right, enjoy the rest of the day, guys. Thanks a lot.